Fed is going to affect the equity market outlook from here. Kathryn Rooney Vera, Baltic Capital Markets Chief Investment Strategist, still with us. Kathryn, Morgan Stanley are quite cautious in terms of their positioning on the street right now, but they make some interesting points about what is going to happen next. We've all got very conditioned to this idea that we're delivering and we're able to manage kind of outsized returns. It's been a fantastic year this year. Maybe we go into a more kind of low single digit, maybe even high single digit return story, but nevertheless, it is going to be single digit. In that kind of environment, do I want to position for the dips, to carry on the conversation last time? Do I need to keep capital back to take advantage of those opportunities, or do I just want to be fully invested throughout this entire process?
Yeah, Guy, I think it's a fantastic idea to have some dry powder on the sidelines for any potential dips. There's a lot of questions still in the air, not only from the COVID perspective, but also from the monetary and fiscal policy perspectives, as well as with economic growth. Is it going to be a steeper slowdown than a lot of people expect? And Morgan Stanley, I just heard from him, but we've also heard from Goldman Sachs, and they've reduced their economic outlooks for 2022 for the U.S. economy a couple times, if I'm not mistaken, in the past week already. So yeah, I think it's a fantastic idea, but I do agree we have to be defensive. So we're going to be buying sectors or even geographical regions that have dragged the U.S. performance a little bit. So healthcare in the U.S. we like. The valuations are still attractive. Banks we like because, you know, we do expect some sort of steepening of the curve in our base case scenario for next year. Rate hikes, banks, of course, are a beneficiary of that. Europe and Japan still have dragged the U.S. performance, so we see additional upside there. Within the emerging market space, there are some selective opportunities as well. So, you know, the markets always present opportunities. We still see some right now. While we are seeing additional upside in equities over the course of the next 6 to 10 months, we are actively advising clients to engage in those, you know, have some cash, have a position in cash, but certainly hold a position in gold, have a position in alternatives, names that have lower correlations with the equity markets.
Hey, Kathryn, does all of that imply a weaker dollar relatively?
Yeah, look, the dollar has countervailing winds. So on one hand, we do expect the Fed to hike rates where their counterparts in Europe are not going to be doing so. But at the same time, we have fiscal deficits that are still, 10% of GDP, and we have a lot of downside to the dollar. I personally think, Alex, structurally, the dollar is weaker and going weaker. But over the course of the next year, as I said, there are some countervailing winds to that theory, and the first of which is a difference between what the Fed is doing and what other developed central banks are doing.
In terms of the emerging market call, where specifically are you looking? It's very easy to talk about kind of emerging markets as if they're all in one bucket, but they're not. Right. How do I separate and segment?
Yeah, sure. So Latin America does present some interesting opportunities. We had a shock election, if your audience has been aware of this, in Chile and in Peru. There have been some really surprises. So next year is going to be a tumultuous year there because we have some additional elections that could jolt the markets. But I do think there are some opportunities. For example, in Brazil or Mexico, both in fixed income and in the equity spaces, there's quasi-sovereigns that are energy-based names that we find attractive in the fixed income space because they have a nice, juicy yield. And also in the equity space, the Brazilian real remains very oversold. Then within China, we like Chinese consumer discretionary. This is a structural recommendation, and China has been beaten up, as we probably all are aware, over the past couple of months. So we do see some opportunities there. So yes, it's not all EM are not created equal, but we do see opportunities, especially in China, in Brazil, and in some cases in Mexico.
So, Kathryn, let's stay on China for just a moment. What kind of policy support do you think we're going to get on the monetary and fiscal front from China that would support your view? Because in theory, they have to do that in order to help people buy stuff.
Well, I can tell you what doesn't support my view. My biggest fear here is that the Chinese authorities decide to devalue the yuan. I think that's a possibility, because if the Chinese, in theory, are accepting a slower economic growth, say 5.5%, are they really willing to cede almost wholly their market share as the yuan appreciates in terms of exports I'm talking about? So this is probably, for me, one of the biggest risks is the potential for a devalue of the yuan to support export markets. But that goes in against what the authorities have been trying to do, which is make China a superpower both economically and politically. And in that vein, they need to support the domestic demand component. So to be supportive of my view, I think that the authorities would have to continue their structural objective of getting China from an export powerhouse and roads to nowhere and ghost town infrastructure-based economy impulsed by government spending towards one based on private investment and private consumption. And I think that's the direction that this economy is going. And that's why we have been recommending at Baltic this structural long position in this area.
Do I buy direct or do I buy the proxies? Do I buy Nike on the fact that it may start to... Nike. I'm sorry. Nike. Got us a victory.
We'll forgive you.
Nike's struggling in China right now. As that starts to turn around, do we start to see some of those consumer stocks that have been focused on China in the past starting to come back strongly? Do I need to go direct to China, or can I buy US multinationals, European multinationals that take advantage of that?
I would buy actively managed funds that focused in China. There are some excellent ones out there, and we're not going to pretend to be experts in all of the subsectors and specific names within China. So what we're recommending to our institutional and retail clients is precisely that: actively managed funds by guys who are focused exclusively on China. That's where we think value is, and that's where we put more faith in the ability for active managers to do that. So that's probably one of our most important emerging market recommendations entering into next year. Of course, there are risks. There's the devaluation. There's additional variants. There's additional closures. There's the potential for really black swans to happen. But the way I see it right now, with the Fed hiking, with global economic recovery, and really vaccines at least improving the fatality rates of COVID victims, I think there are opportunities in those undervalued areas, such as China, such as some emerging markets names, such as Europe and Japan, to outperform.
All right, Kathryn, thanks so much. Really appreciate it. Kathryn Rooney Vera of Baltic Capital joins us.